Good day, students, and welcome to lesson 69. In this lesson, I will mark exercise 4I and 4J. All right, okay, let's start with 4I. Draw up the boarding fees account. I'm quite sure that all of you are quite familiar at this stage with the drawing up of a fees account. So I'm just going to go quickly through it. All right. Okay, let's start. What do we have? They give us a pre-adjustment trial balance. So you know the balance in that account will be the total on the credit side of the boarding fees account. That total, the total is 2473940. All right. And that amount, as I said before, that includes the payment that we received during the year, and it also includes the writing back of the adjustments at the beginning of the year, the reverse entries for the adjustments at the end of the previous year. Okay, so that is the total. Okay, let's see what they say now. Outstanding fees on the 31st of December was 53,600. So that is easy. Accrued income on the credit side of boarding fees account 53,600. And remember to draw your T accounts. Okay, so you're going to open a T account for yourself in rough quickly. It's the accrued income account, and you're going to debit that with 53,600. And on the credit side of boarding fees, we have 53,600. Okay, paid in advance for the next year was 83,900. So it's income received in advance. That's now for the next year. That is 83,900. And you're also going to open yourself a T account, income received in advance. Okay, and then outstanding border fees has to be written off. You're going to credit your membership fees with a fees written off, 17,400. Okay, and you're going to open your T account, fees written off or boarding fees written off. All right. Okay, and then all what is left is to get the balancing figure, in other words, the amount that we are going to transfer to our income and expenditure account. All right, and that is the balancing amount in that boarding fees account is 2461040. All right. Okay, so let's do the rest of the adjustments. Number 2, some expenses for the annual dinner have not yet been paid, 6,500. Okay, now let's see if we've already got an account, if we've already made payments for the annual dinner. Let me just see, annual dinner. Yes, 82,030. Okay, so you're going to open that account. On the debit side, you're going to write total 82,030 in the annual dinner account. All right. Okay, so some expenses have not yet been paid. So we're going to debit that account, debit annual dinner account, and credit expenses accrued or expenses payable. That's the same. Some people call it expenses payable and some call it expenses accrued. Okay, so we're going to credit expenses accrued with 6,500 and we debit annual dinner, that nominal account, the nominal account, what's the number? Annual dinner number N9. Okay, that was the second one. The third one, depreciation is calculated as follows on the vehicles and on 20% on the cost, and then on equipment 15% on the diminishing balance. All right. So the cost price for the vehicles is, let's see what the cost price is. It is 852,300, 852,300. 20% on that gives you an amount of 170,460. All right. So what is the double entry? Open your T account, debit depreciation, and credit accumulated depreciation on vehicles with that 170,460. All right. Okay, and then the depreciation on the equipment, we need to do it on the diminishing balance. So we first going to deduct the accumulated depreciation from the cost price. So it's the cost price was 153,200 less 445,030. All right. And then we're going to calculate 15% on that amount, and that gives you an amount of 163,526. You're going to debit depreciation and credit accumulated depreciation on equipment. All right. So you've got the two amounts now in your depreciation account. If you add the two amounts, you get 333,986. That was your depreciation for the year. Okay. Then we get to stock on hand in the Tuckshop, 53,900. The double entry is we debit trading stock and we credit closing stock with 53,900. Okay, so you open those two accounts for yourself. Okay, and then adjust the interest on the loan account. What was the loan? The loan was 700,000. That must be, let me just see, 700,000 times, is it 23% times 23% gives you 161,000. Okay, 161,000, 161,000. Have we paid interest on that loan? Have we paid it yet? We have already paid 40,250, so it's less 40,250. So what is accrued is expenses accrued is 120,750. All right, so the double entry for that is we debit interest on loan. Remember to enter the balance of 4250 and then add also, and then on the debit side 120,000, 120,750, and we're going to credit expenses accrued with 120,750. Okay. The home has not yet paid, number 6 has not yet paid the manager's salary. We're going to debit salaries. Let's see if we have a salaries account in the nominal section. Yes, salaries and wages. The total there is 622,940. And we're going to debit salaries and wages and credit expenses accrued 40,000. Okay. Okay, so let's start with the trading account for the Tuckshop. Okay, on the credit side, we have sales. We get that amount from the trial balance. Sales 252,030. All right, and then also on the credit side, we enter the closing stock, which was 53,900. That was the adjustment. Remember, we debited trading stock and we credited closing stock. Okay, so now we debit closing stock. So the closing stock account, it close off to the trading account. All right. So that is why we debit closing stock and credit the trading account. Okay. And then you'll see on the debit side we have the opening stock. I know that looks a bit strange because we don't have an opening stock account in this case. All right. We just have that stock account under the balance sheet section. Okay. What was supposed to happen in the beginning of the year is you are supposed to to transfer that stock from the trading stock account to an opening stock account, which is a nominal account. All right. And then if you've done that, then you're going to close off the opening stock account to the trading account. But in this case, they haven't done it. So we did not have like an opening stock account under the nominal account section. We just had that stock in the balance sheet section. But that's not a big deal. I'm just explaining to you why we've got on the debit side of the trading account, we've got the account's name is opening stock, because that was supposed to be in the nominal section, and they were not supposed to be like that stock account in the balance sheet section, if you understand what I mean. All right. So, okay, but in this case, or in the exam, if they don't give you an opening stock account under the nominal account section, then you'll know that the stock that is in the balance sheet section, that stock was actually the opening stock. All right. So you just use that amount and you just enter opening stock on the debit side of the trading account. All right. Okay. So that is that 83050. The purchases, we also enter on the debit side. We close off purchases to the trading account. The purchases we get from the pre-adjustment trial balance, 123,940. And then we just need to get the balancing amount in that account, which we will transfer to the income and expenditure account. And that, in this case, it's 98940. It is the difference between the credit side and the debit side, the amount that we're going to transfer to the income and expenditure account. All right. Okay, let's start with the statement of income and expenditure. Okay, let's start with the current income. The surplus from the Tuckshop, we've just calculated that in the trading account. Boarding fees, we get that amount from the boarding fees account that we've calculated that amount. Okay, and then donations, we get that amount from the trial balance. Let me just see, donations 380. And the same with the proceeds of selling toys 123040. There was no adjustment for that or for donations, so we just got that amount from the pre-adjustment trial balance. Okay, and then we add the income and we get 3023400. Okay, so that is the total for the current income. Then we get to the expenses. The boarding fees written off. Remember when you had that adjustment, you opened the fees or boarding fees written off, you debited that and you credited the boarding fees. So that is where you get that the boarding fees written off that account that you've opened was 17,400. Okay, that was for the adjustment. Water and electricity 52,190. We got that amount straight from the pre-adjustment trial balance. Kitchen expenses 1086250. That we got from the trial balance. The next one is salaries and wages 622,940 straight from the trial balance. Bank charges 4,500 straight from the trial balance. Annual dinner. It was, to remember, there was an adjustment regarding the annual dinner. So we got that. You must have a look at that account that you've opened for yourself, the T account. And then you get the total there was 88,530. And then maintenance of the gardens, 83,100. You get that straight from the trial balance. Pet food, 7,900 straight from the trial balance. And then depreciation, we've opened a depreciation account and we've debited that with accumulated depreciation on vehicles and accumulated depreciation on equipment. And the total there was 33 or 333,986. Okay, and then we get the surplus before the interest expense. There were no interest income, I see. So before the interest expense, the profit or the surplus was 686,604. Okay, let's have a look at the at the interest expense. Was there an adjustment? Let me just see interest. It was for interest on loan. Okay, and the last step is then just to deduct the interest expense from the surplus before the interest expense. So you just deduct 161,000, deduct that from that 686,604 to get the surplus for the year of 525,604. 525,604. Okay, let's start with the notes. The first one is interest expense, 161,000. That was the interest on the loan. 161,000. Okay, then we get to the fixed tangible assets. Those amounts, you get all those amounts in the pre-adjustment trial balance, the cost price of the vehicles and equipment and land and buildings, the accumulated depreciation. You get all those amounts in the pre-adjustment trial balance. Okay. And then under movements, you get the amount for depreciation, and that was the adjustment. We've already calculated that, the depreciation on vehicles and equipment, and we got a total for 333,986. Okay, and then it's the carrying value at the end of the year is just the cost price of each of those items less the accumulated depreciation. So that was the accumulated depreciation at the beginning of the year plus this year's depreciation. So for example, vehicles, The beginning of the year, it was 492,950. This year, the depreciation was 170,000. So that will give you then an accumulated depreciation at the end of the year for vehicles of 663,410. All right. Okay, then we get to inventory stock. That was the closing stock, the adjustment. Trade and other receivables, income accrued. If you look at your income accrued account, you will see that was, let me just get that, income accrued, 53,600. That was for the outstanding boarding fees, 56,300. Oh, sorry, 53,600. Yeah, that was adjustment number 1. Okay, that was for the accrued income. Cash and cash equivalents, you get that straight from the trial balance, the bank and the petty cash. Then the accumulated fund at the beginning of the year, that was the balance. And you add your surplus, the amount that you've just calculated or that you've calculated in your income and its expenditure account or statement. Then we get to trade and other payables. Creditors control the amount you get from the trial balance. Expenses accrued is that 6,500 plus the 120,000 plus the 40,500. Okay. All right. Okay, and then we get the total for trade and other payables of 303,180. Okay, and then we get to the balance sheet of Twilight Old Age Home. Assets divided into non-current and current. The non-current assets, it's the fixed or tangible assets. That amount you get from the notes that we've just done. It's 3,615,534. Okay. There were no financial assets, so that is 0. So the total of the non-current assets is the same as the total for the fixed or tangible assets. Then we get to the current assets, inventories. That was the closing stock for the Tuckshop, 53,900. Trade and other receivables, we've already calculated that, or I've already given that to you in the notes. 53,600. Cash and cash equivalents was also in the note number 5, 37290. All right, if you add those amounts, you get the total for current assets of 144,790. All right, if you add current assets and non-current assets, you get the total for assets 3,760,324. Okay. Then we get to equity and liabilities. We start with the equity. The accumulated fund is 2,757,144. You also got that from that amount from the notes. It was the opening balance plus the surplus. That gives you that accumulated fund balance. And then we get non-current liabilities. The loan from Win Bank, 700,000. So the total for non-current liabilities is 700,000. Then we get to the current liabilities, trade and other payables. I have already done that in the notes. It was 303,180. Okay, so you add the current liabilities plus the non-current liabilities plus the fund or the equity, and that gives you the same amount as the total assets. So it's 3,760,324. So you can be very glad because your balance sheet balances. The balance sheet is in balance, so you know that you've probably done the work correctly. Okay, all right, and then I will mark exercise 4J just now. Okay, let's start with exercise 4J. Okay, it says the trial balance appeared in the books of Something Else Golf Club on the 31st of December 21. Okay, and then the first thing you need to do is draw up the membership fees account, the statement of income and expenditure, and the balance sheet. All right. Okay, so let's start with the membership fees. Okay, so if we start with the membership fees, what information do we have? We have a pre-adjustment trial balance with a total for membership fees of 2,480,000. So it's 2.480 million. So we're going to start that on the credit side of the membership fees account with that amount, 2,480,000. That is the total that you start with. Okay. Then, okay, let's see what they give you under the information. Okay, under information, they say membership fees amounted to 10,000 Rand per member per year, and there were 250 members enrolled. Okay, so immediately you know that is the amount that you are going to enter in your income and expenditure account. So you don't have to calculate that, that is given. So it's on the debit side of your membership fees account, you have income and expenditure 2.5 million. Okay, that is the 10,000 times the 250 Rand. Okay, what else do they say? At the end of 21, 11 members had already paid their membership fees for 22. So you know that is member income received in advance. That is 110,000 Rand. And you always write at the end of the year that adjustment for income received in advance. You debit your membership fees account and you open yourself a little T account, and you the name of that account is income received in advance, and you credit that account with 110,000, and on the debit side of the membership fees you've got 110,000. All right. Okay, and then let's see what's the other adjustment. Okay, do they give you the amount for membership fees that were accrued? Let me see. At the beginning of 21, 6 members had not yet paid their membership fees for 2020. Okay, but that is for the previous year, okay? Of these members, 3 had paid their membership fees, while the membership fees of 3 were written off as irrecoverable. So that is membership fees written off. 10 times or 3 times 10,000 gives you 30,000 Rand. So your double entry is you make yourself a little T account, membership fees written off. You debit that account and you credit your membership fees account with 30,000. Okay. So what was the amount that was accrued for 21? Did they give us that amount? No, they don't give us that amount. But fortunately, we do have all the other amounts in that account. So we can calculate that. That will be the balancing amount in that account. Okay. If we add the debit side, add the credit side, deduct the debit side from the credit side of the smaller one from the bigger one, you'll see there is 100,000 which we have to enter on the credit side. And that is the balancing amount that we've got to calculate, and that is the amount for income accrued. Okay, so open yourself a little income accrued account, and on the debit side, you write membership fees, 100,000 Rand. Okay. Okay, let's carry on with the rest of the adjustments. We start with number 2. Depreciation on equipment is written off at 20% on the cost price. And then they say take into account that new equipment was purchased on the 1st of July for 350,000. In other words, for half of the year. Okay, there are 2 ways in which you can calculate this depreciation. Okay, the first one is you can take the amount for the full year. That was the amount that they give you the balance without that 350,000. So you take that 5.4 million and you deduct the 35,000, then you will get 5,050,000. Okay, so it's 5,050,000 times 20% for the discount, multiply by 6 over 12. Okay, so that is then the depreciation on the amount of, or on the equipment without the new purchases that was made at the middle of the period. Okay, so if you multiply 5,050,000 times 20% times 6 over 12, you get 505,000, 505,000. Okay, and then you Okay, and then you take the full amount for the rest of the 6 months. In other words, it's 5.4 million times 20% times 6 over 12. If you multiply that, you get an amount of 540,000. Okay, so that is the one method. The other method is you can work out the depreciation on that amount that you had for the whole year. In other words, that 5.4 million less the 350,000, which is that 505,000. You can work that out because that is the equipment you had for the whole year. Okay, so instead of just for 6 months, like in the first example that I had, the first example, like where we took it like for only for 6 months. Now we can work it out for the full year, which is for 12 months. Okay, because that is the equipment we had that for the full year. So it's 505,000 times 20%. And then that gives you an amount for the full year, which was 1,010,000. So it's 1,010,000 rand. Okay, and then we work out the depreciation only on that equipment that we bought in the middle of the year. On that 350,000, we're going to multiply 350,000 multiply by 20% for 6 months, only for 6 months. Okay, so it is then 350,000 multiplied by 20%, multiplied by 6 over 12, and that gives you 35,000. Okay, so that was depreciation on that equipment that we bought during the year was 35,000. And on the equipment that we had for the full year was 1,010,000 rand. Okay, so if we add the 35,000 to that 1,010,000, we also get the total depreciation of 1,045,000. So 1,045,000. And that is the same amount that we got when we used the first method. Okay, let's do the rest of the adjustments. It says number 3, refreshments on hand, 35020. Okay, let me just say before we carry on. In this exercise, there is no such section of the golf club that we need to do a trading account for. In other words, we don't have like a purchases or opening stock and closing stock for any of those sections. All right. So they just give us refreshments on hand, 35020. And then just under that, stationery on hand, 2490. That is the plain, straight consumable stores on hand, like you had it in the past. So we debit consumable stores on hand, credit stationery for stationery 2490, and debit consumable stores on hand and credit refreshments 35020. You must just remember to open your T accounts for refreshments and for stationery, and to add and to open it with the totals that were given. The total for stationery was 7350. So you'll have on the debit side of stationery 7350, and on the credit side, consumable stores on hand 2490. Okay, and then only the difference will be transferred to the income and expenditure account. Refreshments on the debit side, the total is 42340, and then we have on the credit side, consumable stores on hand 35020, and only the difference will be transferred to the income and expenditure account. All right. Okay, so let's do that adjustment for the interest on that investment fund. Number 6, the interest on the else bursary fund has not yet been brought into account. Okay, so we start with that. What was the investment on that fund? It is 1.5 million. Investment else bursary fund, 1.5 million. And the interest rate is 20%. Okay, So if we calculate that 20% on that 1.5 million, we get an amount of 300,000 Rand for interest. Okay, so what is the double entry for that for the interest? Credit interest on investment 300,000 and debit income accrued 300,000. Remember, you should already have opened the income accrued account when you worked with your membership fees that were accrued. So in your income accrued account, you will enter on the debit side interest on investment, and on the interest on investment on the credit side, which you're going to open now or have opened, you will have income accrued 300,000. So on the credit side of interest on investment, 300,000. Okay. Then what do they say? They say according to the conditions of the donation, half of the interest has to be used for current expenses, while the other half has to be used for a young promising player to play in the American PGA. The disbursement has already been made. Okay, we had examples like that in the past. So it should be straightforward. What you're going to do is you're going to take out of that interest on investment account, take out that half of that amount is 150,000 that we must transfer to that PGA tournament. If you have a look at the pre-adjustment trial balance, you'll see at the last one, number M12, there has been an account opened for the PGA tournament. In fact, this amount has already been paid. Okay, so when we paid that amount, we credited the bank and we debited the PGA tournament. Okay, so you're going to open your T account with your PGA tournament account with a total on the debit side of 150,000. Okay, now you're going to do that. You transfer the interest from that interest account to that tournament account. So what is the double entry? You debit PGA tournament and credit PGA tournament with 150,000. Okay, and then if you look at your PGA tournament account, you'll see that it closes off. So in other words, there's no expense to transfer to the income and expenditure, and it is correct because that expense has been covered by the interest on that investment. Okay. So, and then they just say then half of that money should be transferred, can be used for income and expenses, for current expenses. So 150 that's left in that interest on investment account. On the debit side, you will have income and expenditure, 150,000. Okay, so these are the entries regarding the interest. Okay. Then we get to the last two adjustments. Wages paid in advance to a golf caddy. So that is prepaid expenses or expenses prepaid. And we're going to debit expenses prepaid with 1,000 Rand and we credit salaries and wages with 1,000 Rand. Remember when you do your T accounts to enter the total. Salary total on the debit side is 593,240. Okay, so you will have that total on the debit side and on the credit side 1,000 Rand. Okay, and you will have on expenses prepaid on the debit side 1,000 Rand. The last one, the fixed deposit was made on the 1st of July, made provision for the interest. Okay, so that was just for 6 months. So if we take that the fixed deposit, the 350,000, multiply by 22%, multiply by 6/12, you get an amount for interest for 38,500. Okay, and that is income accrued. You already opened yourself the income accrued account, so you will have that entry for 38,500 on the debit side, and you will open an account for interest on fixed deposit. We have not received any interest on that fixed deposit, so there's no nominal account opened for that. So you can open yourself that T account, and you're going to credit that with 38,500. Okay, and then we get to the statement of income and expenditure. We start with the current income. Membership fees 2.5 million, 250,000. We add the entrance fees of 100,000, where we get that straight from the trial balance. Sorry, that 2.5 million for the membership fees, we get that from our membership fees account that we have opened. Okay, and then interest fees is straight from the trial balance. And then what they've done here is you see that JOG tournament, we've got an expense and an income. Okay, and if you get something like this, you can deduct the surplus or the expense from the income or the surplus from the deficit or whatever, because it's for the same, like in this case, the same tournament. So you can take the 363,940 and deduct the 207,200, and then you get a surplus on the JOG tournament of 156,740. Okay, and then we get to the expenses. Membership fees written off. You've opened that account, so it's 30,000. Water and electricity. Was there an adjustment? No. So that's 53,400 straight from the trial balance. Affiliation fees straight from the trial balance. Stationery, yes, there was a adjustment that consumable stores on hand. So it's 7530 less 2490. You get 4860. Bank charges you get straight from the pre-adjustment trial balance. There was also an adjustment for the telephone, the 32,570, which was in the trial balance, and you added that 3940 for the adjustment. So the total telephone is 36510. Salaries and wages, there were also that adjustment for the caddy that has been paid for the next year. So the salaries and wages total, or the amount that you enter in your statement of income and expenditure, is 592,240. All right. Then we get refreshments, the amount from the trial balance less that the adjustment. And then we get an amount of 7,320. That was the amount for the refreshments. And then depreciation. We have already opened the depreciation account, and I've already explained that calculation of how I got that amount of 1,045,000. Okay. And then if we add up all those expenses, we get a total expense. Total expenses, the total is 1,824,780. Okay, we deduct that from the current income of 2,756,740, and then we get an amount of the surplus from general activities, which is 931,960. All right, and then we add the interest income, which is 188,500. 188,500. Okay, that was the interest income. We can just have a look at that in the notes. I'll get to that in the notes. Okay, so if we add that other income, the surplus from the general activities plus the interest income, you get a surplus for the year of 1,120,460. Okay, and let's go through the notes to the financial statements quickly. The interest income, which we just had now, was the interest on the investment of 150,000. Remember, that was that story that they said half of the interest can be transferred to the income and expenditure. Okay, that was 150,000. So that is where that 150,000 comes from. And then the interest on the fixed deposit, which was that adjustment for 38,500, was the interest on that adjustment. And if you add those two, you get 188,500. Okay. Then we get to the fixed assets, the tangible assets. They were just equipment. So that's quite straightforward. The cost, you get that from the trial balance, the cost price, plus the accumulated depreciation at the beginning of the year. And then you get the carrying value at the beginning of the year, and then the depreciation that we've calculated. If we deduct that then you get the depreciation for the year. Okay, and then you get the carrying value at the end of the year. In other words, you take the carrying value at the beginning of the year, and you deduct that depreciation for the year to get the carrying value at the end of the year. And that is also the same amount as if you take the cost price and you deduct the accumulated depreciation. And the accumulated depreciation was the depreciation at the beginning of the year. It was 245,000, and we added this year's depreciation of 1045, 1,045,000. If you add those two amounts, you get 1,290,000, 1,290,000. If you deduct that from the cost, you also get that same amount of 4,110,000, 4,110,000. Okay. And then the note for the inventories, the consumable stores on hand, it was for the refreshments. Remember, we had those two adjustments for stationery and for refreshments, and that gives us a total for inventories of 37,510. Okay, so let's carry on with the rest of the notes. Number 4, trade and other receivables, income receivable or income accrued, 100,000 plus 300,000 plus 38,500. 100,000 was for membership fees. The 300,000 was for the interest on investment, that adjustment, and the 38,500 was for the interest on the fixed deposit. And that is if you've drawn up your T account, your income accrued or income receivable account, you would see those 3 entries in that account. All right, and that adds up to 438,500. Expenses prepaid was also an adjustment. Expenses prepaid 1,000. It was for that caddy fee that was paid for the next year, or we are paid in advance for the next period. So that is expenses prepaid 1,000. Okay. Cash and cash equivalents, the amount from the bank and the savings account we get directly from the pre-adjustment trial balance. Bank 72,340, savings account 53,500, and that adds up to 125,840. Accumulated fund number 6, balance at the beginning of the year, you get that amount straight from the trial balance. And then the surplus you have calculated in the income and expenditure account. All right. And also, it's also seen now in the income and statement of income and expenditure. Okay. And that gives you that accumulated fund total of 3595510. Okay. Then we get to 7 funds. We just have that one fund, the else bursary fund, for 1.5 million, and you get that from the trial balance. Then we get to number 8, trade and other payables. Creditors control that amount straight from the trial balance. Expenses payable 3,940. That was for the telephone that was not paid for December, or what was that adjustment? But it was an adjustment for the telephone, and that is where I get that expenses accrued or payable, expenses accrued or expenses payable, that 3,940. If you've opened that account, you would remember to enter it under trade. And other payables. Okay, and then we get to income received in advance, and that 110,000, we get that from that membership fees, the adjustment in the membership fees account. That adjustment under number 1, where it says 11 members have already paid their membership fees for 22, so it's 11 times 10,000. That is where we get that 110,000 from. Okay, and now we get to the balance sheet. And I'm not going to explain each and every amount because we've already done that under the notes. So I'm quickly going to go through that. You know by now assets are divided into non-current assets and current assets. Fixed or tangible assets, we get that amount. That is the carrying amount, and we get that from the note to the financial statements. Okay, and then we get to the financial assets. There were 2 entries under financial assets, the investment in the else bursary fund and also the fixed deposit in BBB Bank. Okay, the investment is 1.5 million and the fixed deposit 350,000. If you add that, you get the financial assets of 1,850,000. Okay, and if you add that to the fixed assets, the tangible assets, which is 4110000, you get that non-current assets of 5960000. Okay, then we get to the current assets. Inventories was 37510. Trade and other receivables 439,500, and cash equivalents 125,840. If you add those three amounts, you get 602,850. All right, that was the current assets. Add current assets to non-current assets, and you get the total assets of 6562850. Okay. Then we get to equity and liabilities. The members' equity is 5095510. We've seen that from the note. The accumulated fund is 3595510. And the funds is 1.5 million. So it's 1500000. Okay. And then we get the current liabilities, which is 1467340. There were there's no non-current liability, so there was no loan. So if we add that, the 5095510, that was the total of the accumulated fund and the funds. If we add that, that equity, the members' equity, if you add that to the current liabilities, you also get an amount of 6562850. Okay, and that is the same amount as the assets. So you know your balance sheet balances, which is correct. Okay, that is all for today. I'll see you in lesson 70. Goodbye and keep well.